Guys, the stock market has been absolutely clobbered in the last couple of weeks. We have seen massive moves on the S&P 500 on the Nasdaq. We have officially entered a bear market. So now the question is, how far do we think this market still has left to bleed out? When do we think is the bottom? I'm going to be answering that question for you in this video. So make sure you tune in, watch the video until the end if you want to protect your portfolios. It's absolutely crucial that we have a sense of what is going on in these markets and how best to protect ourselves. So stay tuned. We are going to cover that in this video. I have been telling all my friends, my colleagues, my Discord group, my video that I shared in the last 2 or 3 weeks. I can't remember the exact date, but I have been telling you that I expected further downside and a bear market. Okay, we have officially hit a bear market on the Nasdaq. We are almost around that territory in the S&P 500, not quite there yet, but massive moves on tariff fears. So first, before I dive into the charts, guys, I want to give a little bit of an explanation in regards to what's going on politically. Okay, I don't usually do this in my videos, but we have to cover the macro backdrop to understand why this is happening. Okay, so this is obviously my opinion, not financial advice. You have to do your own research, but I have been of this opinion for a few months before this administration came into office. So basically, I'm going to keep it very simple. I think what's happening here is the US has $7 to $9 trillion of debt that they need to roll, okay, this year. Okay, that's a hell of a lot of debt to roll forward, and they want to roll it at significantly lower rates, which is the 10-year yield. So the 10-year yield, since this new administration has come in, we have seen the 10-year continuously, week after week, it's plummeting. Okay, so Scott Bessent has made this quite clear in his playbook. He is targeting the 10-year yield. They want the yield to come down, okay, because the Federal Reserve are being very stubborn. They're using, obviously, for valid reason, inflation is still sticky, but they're not giving in to this administration. They don't want to appear weak. Obviously, I said, before President Trump came into office, that I thought there's going to be conflict between Jerome Powell and President Trump, and we are seeing that right now unfold. Okay, so Trump wants rate cuts. Powell's being stubborn. So what does Trump do? He wants to force the Fed's hand. So how do they do that? They crash the markets. They want pain in the markets. They bring down the yields. Investors are fleeing to safety right now. They are all piling into the 10-year bonds. Okay, everybody's piling into bonds right now because that's the safety, and we're seeing yields come down significantly. We actually on Friday hit around 385 on the 10-year, the lowest yield we've seen for a while now, okay, for a few years. So the 10-year, they're getting the job done. I think Scott Bessent, from my knowledge, said he wants it around 3.5%. That's still a little bit more work left to do. So that's why I still think there's a little bit more pain to come in these markets before they hit their target, before the Federal Reserve are forced to cut rates. Okay, they're gonna be forced. They have to show their hand at some point. A little bit more pain in the markets. I think the Federal Reserve will have no choice to step in and cut rates as early as May. Okay, we have around now the markets are pricing in a 70 or 80% chance of a rate cut in June. But I think if we continue seeing a sell-off in the stock markets and the yields tanking further, I think that the Federal Reserve will be forced to step in and cut rates. Not only that, I do think they're going to have to stop quantitative tightening. They will start adding bonds to their treasury holdings. Okay, so I do think they'll have to add more liquidity to the markets. They will have to expand their balance sheet. They have to do it. Otherwise, there's no way that the government can fund the deficits. Okay, whether they make these cuts, the tariffs, that is going to take a long time before you see the advantages, before you see any sort of meaningful impacts on tariffs. The tariffs, you know, they're going to bring in billions of dollars if they go into effect fully, but you're not going to see that right away. So that is going to take time, and the US has a lot of debt to roll. So that's not going to happen. That's not going to solve the deficit problem. So the Federal Reserve will have to step in and they will have to print money. It's as simple as that. That's the game. That's the game they created. So that's the playbook. That's the playbook that we all know. And I don't think that playbook is going to change anytime soon. Maybe towards the end of the administration period, they start bringing in the government spending. Maybe the GDP is, debt to GDP levels can balance out, and the market can move forward in a more natural way, and we don't have to go through insane amount of money printing. But that is, in my opinion, in the future. Maybe this administration is trying to pull it off because obviously this game that they're playing right now, it cannot go on forever. Okay, it cannot go on forever. So I do think there is radical changes ahead. So that is the playbook. I believe there is more pain in the market. Okay, still some more pain in the market, but I think we are closer to a bottom now. We are closer to a bottom, and I want to be positioned now to take full advantage of when that happens. Okay, I think 10 years going to come down to 3.5%, around that level, 3.5, 3.6, might not be exact. And I think the stock market, a little bit more pain before the Federal Reserve have to step in, cut rates, and print money. Don't think there's any doubt about it, in my opinion. I think they will have to do it. Okay, Trump will get his way because he is creating panic throughout the world with tariffs. A lot of talk right now in the news regarding recession. Okay, we're hearing it all over the news. We're getting a lot of softening in GDP forecast. Okay, we're getting consumer sentiment, and the soft data is very poor right now. Everybody is scared. So when you get recession whispers in the US, that freaks out the world. They all pile into treasuries. What does that do? That brings down the yield. That's exactly what they want. Okay, so whether we get a recession, maybe they declare it after the fact that we were in a recession right now. Maybe, I don't know. But one thing is, they are getting their way eventually. Trump will get his way. Okay, and this is the way he's doing it. He's causing short-term pain, just like he said. He said the exact thing, guys. He said this. He said there will be short-term pain, but in the long term, it's going to work out fantastically. And I actually believe him. I actually believe his words. I do think that's the playbook. It's pretty clear what he's doing. So enough of the macro stuff now, but it's very important that we understand what's going on in the macro, because the macro is driving this market, guys. The macro is driving it. And until the macro picture clears up, that for me is probably around the end of April, May, or most likely when the next FOMC is, which is in May next month. I don't think we're going to see a bottom in this market until then. Okay, but we're going to get short-term bounces, in my opinion. However, I think they'll be short-lived. We have some more pain to come in the foreseeable. So enough of the macro. You're here for the charts. where is that bottom? I'm going to give you my opinion in this video. So let's dive into the charts. Let's see what has been going on. All right, guys. So if you saw my video from a couple of weeks ago, I told you that we had a bearish Elliott wave count, and we have a also an alternative bullish Elliott wave count for another, another push to the upside to complete a fifth. So this was the bull. Okay, 1, 2, 3. The 4 was actually here, and we were going to get a fifth wave. That for me is not on the cards anymore. I did tell you in that video that I think that we have a lot more downside to go. We have more downside to go, and I believe that we were going to eventually hit into a bear market. If you go and watch that video, that's exactly what I said. So we have been positioned for that. We have been protecting our portfolios. We have been hedging with options. So we have been nailing these markets absolutely perfectly. Obviously, I was not on YouTube back during this time, but in November 2021, I was bearish. I sold all my stocks here, guys. Last time I sold all my stocks, and then we got a bear market. All right, I was in other Discord groups. I was telling everybody that we're going into a bear market. I am selling. Nobody believed me. Everybody laughed at me, and yeah, what came next was a big flush in your heavy tech stocks, right? You saw Netflix, Facebook go down 70%. I was giving these price targets at that time. Nobody believed me. They were all laughing, and they I'm safe to say they're at their words, right? They're at their words. Okay, so I called pretty much the bear market. Once we broke this low, I was pretty convinced we were going into a deeper correction, if not a bear market, but a deeper correction. But if you saw my video from last week, I thought this is probably heading in most likely into a bear market. So I had this ABC. This is obviously it's happening a lot faster than I would say. But when we were here last time, so we got this bounce. All right, we got this bounce. I was predicting that we're going to get this bounce here. All right, and we had the reason why that was bouncing is we had we moved into the golden pocket. All right, it was a very nice move. Okay, this move was a very nice move. We bought some stocks for a little bit of a swing trade. We made not too much on them, 8 to 10%, and then yeah, when I said when we get up here, I'm going to be looking to take profits. That's exactly what happened. I came out of those positions. And we've been buying puts on this market since, and they're up really nice, right? Safe to say, we back tested this support, turned into resistance. Pretty standard TA what happened here. Okay, I expected a little bit higher. To be fair, I expected a little bit higher, but it's just the market was so weak, right? Didn't even get up to the 0.5 on the Fib here. Didn't get up to the 0.5. Got up to around 45 on the Fibonacci. Just back tested this support level, turn flip resistance. Couldn't get through it, and we tanked obviously on the tariff news. Yeah, it was a really bad. But it was a bad day, right? We tanked really hard. I think this was a drop on the S&P 500, 10% drop. I mean, you don't see 10% drops on the S&P in a week, right? Even during COVID last time, I don't see 1 week where we dropped 10%. Maybe here, yeah, 11% we dropped. That was during the COVID. I think that happened twice, maybe happened twice. Yeah, 14%. That was wild, right? Really wild crash. COVID. I don't think this is, this is nothing like what was going on during COVID, guys. All right, the world shut down. Far worse than what's going on right now with tariffs. Okay, nonetheless, the market this is a very exaggerated sell-off. Nonetheless, I predicted it. And that's what's happening right now. So we are down around, let's do this properly. Okay, with a measuring tool, we are down 17.5% on the S&P 500. So we have around another 2.5% to go for what they class as a technical bear market of a drop of 20%. Okay, they class this as a they were classed at that time as a bear market, a 20% drop in price. Okay, so I still think we have a little bit more downside to go. All right, and yeah, really wild move. I'm going to tell you what I think is happening. Okay, I still think this is, well, I hope this is an ABC. All right, I hope this is an ABC, and then we can start moving away from here and start another bull market. Okay, that's the wish for everyone. So what I want to see now is, I think this is a 1-2. This is going to be 3-4, and we're going to get one more flush down. Okay, probably into these areas. I'm going to show you the areas that I think we're gonna likely find a bottom in this market. Okay, likely going to find a bottom. You could even see, if we get a 20% move on the S&P 500, you could see emergency Fed rate cut. I wouldn't be surprised by it. I would not be surprised, but we've seen crazy things happen before. I wouldn't be surprised if the Fed came out and cut rates. I just wouldn't. I wouldn't. Right? I wouldn't be surprised by that. So, for me, I think a bottom is close, guys. I think a bottom is close. I really think a bottom is close, and I think we're going to bottom in this green box, and I'm going to show you why. Okay, so I pulled volume. All right, I pulled volume. I pull volume from the COVID lows to the top of what's going on right now, and you can see that we have the value area high sitting at around 4,800 on the S&P 500. That's the target for me. 4,800, I think, is the target, guys, for me. I think that's where we're likely to find a bottom. Yeah, you can see the 0.5 also sits right on the value area. So let me just, yeah, it's fine. Yeah, so the value area high sits on the 0.5 Fibonacci level. If we look at where we bounced last time, it was also toward, yeah, right on the 0.5. Okay, on the fib. So this leg of the bull market was corrected 0.5, and we started a new bull market, and I think that's where we're likely heading. Okay, towards this 4,800 level on the 0.5 Fibonacci, which is also lines up with the value area high, and also the the prior all-time highs that we have here, which is gonna resistance flipped into support. So that's quite a typical technical pattern. So I think this green box that I have drawn here, I think that's where we're looking likely towards a bottom. All right, so that will represent a 22% drop on the S&P 500. And then what I want to see, obviously, a new bull market. A new bull market. That's what we're hoping for. I mean, if we get up here and we could put in a flat pattern. What do I mean by that? I mean, it depends on the narrative here, guys. All right, so we could get back up just past all-time highs. If we then get a confirmed recession, okay, next year, maybe December, January, then this, you could say this is going to be 5 waves down, all right, for a deeper pullback towards this point of control, right? So for me, you can well see this. This is what we call an expanded flat correction in Elliott wave. So you can have a 3-wave move back up. So obviously this will be 3 waves, not 5, and then you get 5 waves down in a C wave. Okay, so that would be A. This would be your B wave. This is the A wave. This is the B wave. This is your C wave, right? That's how an expanded flat will work. If we don't get a recession, okay, if we don't get a recession, then I think you're starting a new bull market, and I would want to see 5 waves out of here. All right, I would want to see 5 waves out of here. Another thing I want to know, I want you guys to know is if this is a 5-wave move, right? If this is a 5-wave move, then this is likely the start of something rather than the end of something. Let me explain further what I mean. So, what do we have here? So guys, what I mean by that this is a 5-wave move down is the start of something rather than the end of something. Okay, so what do I mean? I mean, if we get a 5-wave move down, then that is either an A or a 1. We're going to get a B wave or a 2, and then you get a C wave or a 3rd wave. Okay, so what I mean is if you get 5 waves down, aggressive 5 waves down, then that is either a wave A, which is the start of something, or a wave 1, and then you're going to go into a B wave and then a C wave down to complete the correction. Okay, so we don't want that, right? We don't want to see that. However, if we get, we open on Monday, we get a little bit of a move like this, okay, this becomes the partner of the 1 and 2, all right? This becomes a partner of the 1 and 2, and we get down and put in a 5th, okay? That is not going to be a good sign. So we want a partner to the smaller leg, guys, all right? This is what we want to see, okay? What do we mean? This correction here, okay, this leg took around about a 10-day correction. The smaller 1, 2, okay, the smaller 1 and 2, okay, rather than the AB, okay, the smaller 1 and 2 took like 2 or 3 days. So this is what I want to see, okay? So for example, we move down and then we move back up, okay? I want to see a 2 or 3 day move higher and then a sell-off, all right? That would be a 1, 2, 3, 4, 5. That would be a partner to this move, not this, okay? Not this one. So rather than being 1, 2, 3, 4, and 5, you got an ABC completed correction. All right, so this is very, very important what we're about to witness here, guys. All right, so I'm paying close attention to this because this will tell me everything, whether this is the start of a bigger correction or the end. If we do get 1, 2, 3, 4, and 5, okay, then expect that this is going to come a lot lower, guys. All right, nonetheless, you're going to get a bounce. You're going to get that this will then be an A, B, okay, you'll see a rally, okay, and then you get a C wave down for a lot more pain. This would fit the narrative of recession by August, September, okay. This will fit a narrative of August, September recession, and we come down, we sell off, right? You're looking at that time around 35% correction. So yeah, that would fit the narrative. This is why the next week, this week coming up, is so important. All right, because this will determine whether this is going to be 1, 2, 3, 4, 5, okay, or is it going to be 1, 2, 3, 4, 5 into a bigger correction. That will tell me everything. If we rally out of here, then yeah, obviously we've finished the correction at that point, and we can look for higher targets. All right, so I'm keeping it pretty simple. Nonetheless, this is my target around 4,800 on the S&P 500. I will be buying pretty heavily at that point. Okay, I'll be allocating quite a lot of my capital into the markets at around 4,800 on the S&P 500. My favorite names, obviously Netflix, Facebook, Google, Amazon, Apple. Okay, Nvidia. Nvidia is actually down 40%, guys. All right, that's, yeah, you can't ignore that. All right, I don't think investors are going to be ignoring that either. I do expect a bounce on Nvidia. All right. In regards to Bitcoin, guys, Bitcoin, yeah, pretty surprising what's going on here, right? It's not selling off, which is, yeah, maybe this is, this is front run the stock market. This is front run the stock market, and you're going to see a bounce on the stock market. This is front running the stock market, but we are seeing a little bit of a sell off over the weekend. Nothing heavy right now. The altcoins are getting clobbered though, right? The altcoins are just getting absolutely smashed. Again, Bitcoin dominance is going a lot higher. It's at 63%. Yeah, this just continues to soar. I do think I do see Bitcoin dominance coming to our top here, guys. All right, I do think it's coming closer to our top around this this wick here. I think you're going to see a move down on Bitcoin dominance. That should give some relief to the altcoin space. If Bitcoin obviously continues to pump, I think the altcoins will pump harder than Bitcoin, because I do see a local top. Whether that's going to be the top, I do see a local top on Bitcoin dominance, and if Bitcoin can get out of here, this downtrend. We've got that chance of it's looking less likely that this is 1, 2, 3, 4, 5, because it's just the length of this and the time that it's taking. It doesn't quite correspond to this. If you know Elliott waves, so I don't know. We're gonna have to see. For me, I'm right now just paying attention to the stock markets, because the stock market, I think, will drive asset prices. Whether it's Bitcoin, I know Bitcoin is decoupling right now, but I don't think personally that decoupling is going to last a lot longer. You can even see gold is selling off, right? Gold sold off quite heavily. Gold has been rallying, making new all-time highs, whilst everything else has been tanking. And that's not because gold doesn't sell off when other assets sell off. That's not the reason. There's another underlying reason as to why gold is continuing to make all-time highs whilst everything else is selling off. In a recession, this thing is going to get clobbered. All right, make no doubt, make no mistake. But for me, I think the reason why this continues to make all-time highs is because central banks around the world have been heavily stacking gold, especially the Chinese, because the Chinese, they measure their currency against the dollar, against gold. Sorry, they don't measure it against dollar; they measure it against gold. So they have been they're in debt deflation right now. Okay, they've been printing a lot of money. Okay, because they have to. They're in a bad state right now. They're printing a lot of money. That is actually helping the gold price, because China have been buying gold, as you know, by weakening their currency. That's continued. That's continued to help the gold price go higher and higher. Okay, that's continued the gold price to go higher. So that's the reason why I think, a couple of reasons why I think gold has been making all-time highs whilst everything else has been tanking. And I also mentioned at the start of this video, the 10-year. Okay, you can see since this administration basically came in, right? They came in here, guys. That was the top of the market on the treasury. We were at 4.8%. We're down to 3.8%. That's 1% move. That's a huge move, guys, in the 10-year treasury, right? People have been piling into bonds, right? Piling into bonds because of the fear that's been created with the tariff noise, and also the fear now that you see in the stock market. And this week has been a huge sell-off, right? 4.4% all the way down to 3.8%. So that's a really big move on the 10-year treasury, I do think they're going to bring it down towards 3.5, 3.6. This is the target for me. This is going to be the target. All right, guys, 3.6, 3.5%. That's going to be Scott Bessen's target. All right, it could come lower. We could come lower, 3.3. The lower this goes, the better it is for them. But obviously, we don't want to continue seeing this, because investors are just piling into bonds and selling stocks. So you want to see some relief, right? You want to see some relief in here. So I do think if the stock market continues selling off, yields will continue going down. Okay, I think yields will continue going down towards this 3.5, 3.6 region, and then we can get a bottom in both yields and the markets. All right, so I think the plan is coming to fruition. Okay, and I think we are closer to a bottom than we are closer to a top right now. All right, so if you haven't already sold your stocks, I mean you're down, you're seeing your portfolio bleed out, I don't think this is the time to be selling your stocks right now. You're already down 17% on the S&P 500. You're closer to the bottom. You rather hold on now, because you're gonna see a significant bounce. If we confirm a recession, you're still gonna get a significant lower high rally. Okay, if you want to sell, you'll be wanting to sell your stocks in a lower high when the stock market makes a lower high, when we get a bear market rally. If that is a bear market rally or a bull market rally, where time will tell, we'll have to obviously assess what the macro picture looks like, what the stock market is looking like. All right, so if you haven't already sold, this is not, for me, not financial advice, but this is not the time to be selling. This is actually, if you've got spare cash on the side, you want to get ready to start allocating a little bit more capital to the markets, because right now we have a fear index. I think I saw it last on Friday, was like 4. Right, we haven't seen this type of fear in the market since COVID. Everybody is in deep panic mode. So when people are fearful, you want to buy. Old saying, the old man said that right before. Okay, so you want to, if you've got spare cash on the side, you want to get ready to start buying. All right, it's as simple as that, guys. You want to start buying the S&P 500 at major levels. Even if you bought right now, I wouldn't say that's a bad buy. I would not say that's a bad buy. That is a good buy if you bought on Friday. If we continue to go lower, in my opinion, we will. We have a little bit more pain to go. But if we start seeing a little bit lower prices, you can start adding a little bit more cash. Okay, that's my plan. I haven't bought anything yet. I still want to see a little bit of a stabilization in the markets. Okay, but if we get to my price target of 4,800 on the S&P, I will be allocating quite heavily, and I will be sending out these alerts in the Discord group way before these videos come out or any reels come out or anything like that. You will get access to the alerts when I send them out. They are absolutely free. I've been nailing this market absolutely perfectly, guys. And I want to help you guys stay away from danger. I want to help you guys build wealth for the future. If you want to be a part of my journey, if you want to be part of our group, absolutely zero cost, doesn't cost you a single penny. Come and be a part of it. Link in the description for the Discord. It's going to save you a lot of pain in these markets, because I have been around these markets for a very long time. I know how to navigate these markets a lot better than a lot of hyper YouTube people. Okay, hyper YouTube people who are just selling you views. That's all they're doing. They're getting you burnt. There's people out there that are shilling altcoins. They're shilling all sorts of crap, and we don't want you guys to suffer from that. Okay, so anyways, guys, that is it for this video. Stay safe, guys, out there. Protect yourselves. Don't overly get scared here, guys, and start selling. Not financial advice, but don't get overly scared here. All right. Stay safe out there, traders. Peace out.